Welcome to the Accounting for You podcast, brought to you by the accounting firm of Adkins and Reynolds CPAs. This podcast is designed to provide relevant tax and accounting information to help you and your business succeed. If you enjoy listening in, please like and subscribe to our channel. Now, on to the show. We want to welcome you to our first episode of the Accounting for You podcast. My name is Chris Reynolds. I'm a CPA and partner with Adkins and Reynolds CPAs.
And I'm Jay Adkins, CPA and partner with Adkins and Reynolds CPAs.
So we want to get right to the first show because this is an important, right at the end of the year topic. We've got 5 last-minute tax tips for business owners and some individual tax tips that may help the individuals out there. So we'll get right to it so we don't waste any of your time. Big 5 last-minute tax tips. All right, number 1, we're going to want to increase your contributions to pre-tax retirement plan through work. And this is going to be like your W-2 employee. Jay, what you got on that?
Well, we have some different contributions that we want to discuss, different options. First, we want to look at the simple, which is the lowest level of the retirement plans. You can contribute up to $14,000 per year. Unless you're over 50, there's a catch-up clause where you can then do $17,000 per year, and employers can match up to 3% for that. We also have the 401k, which is the most traditional that most people know about. The contribution level on that is $20,500 per year, or over 50s can do $27,000 on that one. Lastly, we have the SEP IRA, which allows the most to be contributed. That can go up to $61,000 as a max. Anywhere from that 0 to 61, and you can do that by a percentage of wages.
All right. So, but it's important to remember that these are really for W-2 employees. So not all of these would work if you're like an independent contractor or if you don't have employees. Some would, some wouldn't. And that's where you might want to call us and we can kind of give you some advice on maybe what would work best and hook you up with a professional that could handle those type of accounts. All right. Tax tip number 2. There are 2 types of taxpayers. We have cash basis taxpayers, which most individuals, or I guess all of individuals are, and then businesses have the option to be cash basis or accrual basis. So if you're a cash basis taxpayer, it's important that any expense that maybe you've got coming up in January, February timeframe, that you might want to go ahead and speed that up to the end of the year. And that way you get that deduction now as opposed to into the following year. And then you've delayed that tax benefit all the way for another year. And, what's the point in spending money, in January if you could have got that tax deduction, in December? But it's important to remember, don't be spending money to save money because that's just, that'll get you broke quick.
Absolutely.
Wouldn't you agree?
Absolutely.
So, all right. And that kind of leads us into tax tip number 3, which is if you're planning any capital spending in the first 3 months, you might want to speed those up to December. Jay, what do we mean by, like capital spending?
Capital spending is when you're buying vehicles or office furniture or office equipment. We can deduct those immediately as long as you buy them and place them in service in December. That's going to be an immediate write-off and a tax deduction there. The one thing you want to watch out with those is I get the question a lot of times, should I buy this item to get the tax deduction? Well, if you need it or you will need it within the next few months, then absolutely buy it in December, place it in service, take the tax deduction this year. But do not buy something that you don't need because you're causing yourself economic harm. You're basically spending $1 to possibly save a quarter, and you don't want to do that. So you definitely want to buy the things you need within the next few months at the end of the year, but only if you need them.
And keep in mind, we've got an episode coming up that's going to talk a lot more about that in depth. But yeah, it's very important. It's a good way to go broke. Is the gist there. So we do not want to advise clients to go broke. So that's not good for any business, right? So all right. Tax tip number 4. We're going to say make sure your charitable contributions are cashed by the charity by the end of the year. So you can make charitable contributions by cash, check, or credit card, but it's important that if you're writing a check to that charity, the technical rule is the charity must cash it by the end of the year. Now, it's probably not the best thing to maybe call up the charity and say, hey, are you going to cash that check because I got to get it for my tax deduction? But just keep in mind, try to time those maybe earlier in the month. Don't be trying to make a contribution right on December 31st because technically they may not qualify if you're ever audited and the IRS starts going through line by line on all your deductions. So, and of course, with itemized deductions being what they are under current tax law, a lot of individuals don't even qualify to take charitable contributions. So it's good to obviously give to charity, but if you're doing it strictly for tax benefits, it may not be the best option for you to save money on your tax bill this year. But that's something where you could call us and we certainly could talk to you about, what qualifies as itemized deductions, if you're going to have enough itemized deductions to do anything, and just to kind of make sure that you're set on that. So I think for my tip on that is do it at least a week before the 31st, just to be safe.
Absolutely, because the last thing you want if you ever get audited is you have a contribution that you made in December and took the deduction in that year, but then the charity provides you paperwork that shows a contribution received in January of the following year. That can just cause confusion and doesn't provide the substantiation you need from them that the IRS may want to see.
Yeah. All right. And now our fifth and final tax tip, and that is do a tax projection to make sure you're ready for April the 15th. What do we mean by a tax projection?
Well, what we normally like to do in November and December with our clients is go through and do tax planning. We'll take a look at what was on the tax return last year. We'll talk to the client about what's happening this year, if income is up or down, or there's anything going on that maybe wasn't there in the prior year. And then we will work up a tax projection to see what's going to be happening on the tax return in March or April, depending on the due date, so that the client may know 5-6 months ahead of time a good estimate of what to expect in the spring. The last thing that you want is to have a tax return prepared in the spring and have a big balance due and scramble to pay that. It would be much better if you're going to owe taxes to know that 5-6 months ahead of time.
Yeah, and it's also a good idea. That also gives us some time to maybe advise you of saying, hey, maybe, this is not the year to speed up that equipment purchase because maybe next year you're expecting a big income in January, February. Maybe now's the time to wait till next year to purchase that piece of equipment. Or maybe we say, yeah, definitely, if you're going to buy that truck, let's get it in this year. So it gives us the opportunity to do some planning for you by the end of the year also and show you the benefit of maybe investing into what we were talking about earlier, the simple IRA, maxing out your simple IRA, or making sure that you've got those expenditures done by the end of the year, or other avenues of tax planning that we may have that may be applicable to your current tax situation. So, Jay, do you have anything else you want to add to this episode?
Actually, I do. Back on tip number 2 about paying your expenses. This year, one big thing you want to avoid as a cash basis taxpayer, you do not want to write checks and take your bank balance into a negative. You are not allowed to deduct expenses if your bank balance is negative. So pay any bills that you have as long as you have the cash in the bank. You can't write checks, take your cash to a negative, hold them, and mail them out later in January. That's not allowed. So certainly make sure you're paying bills with money you actually have.
Good advice. All right. Well, I want to go quickly over the 5 tax tips before we close out of here. Remember, number 1 is increase your contributions to pre-tax retirement plans. Number 2, if you're the cash basis taxpayer, speed up any of the first of the year expenses into the end of the current year. And remember, don't take your cash balance negative. Number 3, if you're planning any capital spending in the first 3 months of the following year, maybe is a good time to speed that up into the current year. Number 4, make sure your charitable contributions are cashed by the charity by the end of the year. And lastly, do that tax projection so that we can maybe forecast what you're going to owe in April or give you the ability and time to do a little bit of tax planning and some maneuvering there to benefit yourself. So I think that's all we've got for this first episode. So we'll see you next time. Thank you for taking time today to listen to our podcast. We appreciate listeners like you and ask that if you enjoy what you hear, please like and subscribe to our channel to ensure you receive the latest episodes as soon as they come out. If you have any questions about the topic we discussed today or would like more information on becoming a client, please do not hesitate to contact our office by visiting arcpas.com or theaccountingpodcast.com.